great. It's a pleasure to be in front of the room here. There's certain names that just kept coming up over the years. And when you talk about apartment valuations, the barriers are definitely there. And, Mark just talked about the east side, the west side. I grew up, as Mark would tell you, in a USC house. And my father would always talk about the Cal Stanford game, the big game. And our speaker today is actually got his BA at Cal. So the big game, we'd always talk about that game. And he had some pretty fancy finishes to that game over the years, too. But, Mark's, it's a pleasure to have him here. He's a veteran of more than 5,500 appraisals. And he got his MBA in real estate from American University in Washington, D.C. In 2012, his son Patrick joined him. And it's a pleasure to have you here, Patrick, every year taking on more of this load. And his education was actually in electrical engineering, and he'd go into projects and figure out all that electrical stuff. So we were talking about some different issues earlier. I said to my daughter, I said, I just don't know how to think that way. So when you start looking at all those little pieces and how they all go together, it's pretty interesting to me. I got to figure out how many amps to go with the ohms and speakers and all that stuff. So I appreciate that. But without further ado, I'd like a nice warm welcome for the Berries. It's going to be a very interesting presentation, a great way to start off 2018, which I think is going to be a wonderful, wonderful year. So thank you.
Great. Hey, thank you so much, David. About 30 years ago, I was just starting out as an apartment appraiser, and I'd been in business maybe a year or two, trying to get a toehold, trying to get things going. And all of a sudden, one day, I got a call from Jim Baker. And Jim was the president of the CCIM chapter, and he asked if I would be the speaker at one of their meetings. Well, the meeting was held in a back room of the old Red Lion, and there were probably 10 or 12 people there. But it was the first time that I had ever been asked to give a speech to a group. And so since then, there have been a lot of changes in the CCIM chapter. And I cannot believe the development and the growth and the professionalism, what's happened with this chapter. And this is probably the 30th time I've been to speaking before this group. I am so honored by the invitation, and thank you so much for having us back this year and back all these years. Now, here we are in early 2018. So what kind of year was 2017? Well, it was really a pretty good year for the real estate market and a pretty good year for the Portland apartment market. We gained 26,000 jobs. We had record low interest rates, a record low unemployment, about 3.9%. Interest rates dropped about 30 basis points over the year. Apartment vacancies are less than 4.5%. We have a record high stock market, and the tax reform bill is passed. Fortunately, the tax reform bill has preserved the 1031 exchanges and also helped any of those of us involved in pass-throughs like LLCs or sole props or subchapter S's. However, the apartment market took a few blows on the chin in 2017. Certainly, it was an adverse political climate, which had an impact on operations. Also, we had very high apartment construction, which is finally starting to have some impact on apartment vacancies and apartment rents. We also had property tax increases, somewhere in the range of 6 to 12%. But nothing seems to knock the apartment market off its perch. And in 2017, apartment values went up somewhere between 15 and 20%, with new highs across most of the submarkets throughout Portland Metro. So what I'd like to talk about today is some of the major trends that happened in 2017, and then some thoughts where the apartment market is going in 2018. Now, specific topics include some macro issues. I'd like to talk about what's happening with interest rates, employment, population growth, home ownership, and apartment construction. We're also going to talk about what's happened with some of the operating fundamentals of apartments this last year. In particular, rents, income, vacancies, expenses. We're also going to talk about apartment sales, including what's happened with volume and what's happened with the number of transactions, and also with apartment values. And then I'm going to talk fourthly about some kind of random thoughts, things going on in the market, and then conclusion on kind of where the market is going, some thoughts for 2018. Now, last summer, I had a little problem, and that was that in the basement storage area where we keep our files, we had a leak. And so we got the insurance company to come out, and they had the company there with all the humidifiers and the blowers and the fans. So we had all these files spread out in this basement area and storage area. And after about a week or 10 days, I decided to go down there and see what was going on. Well, there were all these files spread out, and I couldn't help but getting distracted. And so I'd stop and I'd pick up this old appraisal and that old appraisal and this one. And finally, I didn't get any work done down there, but it sure brought back some memories of the different cycles and what's happened. And I had a chance to look at things like past cycles with employment and construction and vacancies and rents and values and cap rates. Now, one of the files I picked up, it showed that values were at a 12 cap and 5 times gross. And now it's probably closer to 12 times gross and a 5 cap. So what it made me realize after looking at all these files that were spread out was that we have never been in an apartment market like we have seen the last 3 years. And the big question I have, and I'm sure a lot of you who work the apartment market in this room have, is it different this time? Is this the new normal? And will we return to the mean? Now, looking at some macro issues, one of the first things I want to know about is what's happening with interest rates, because it has such a huge impact on the apartment market. We started out the year somewhere around 4.3%, and it went down a little bit, maybe 3.8. We're up closer to 4.0%. But it has a huge impact on values. If we look at the spread between a certain index and cap rates, you can see there's a steady spread between cap rates and the interest rates of somewhere around 150 to 200 basis points. So if interest rates go down, cap rates will go down and values will go up. And it's one of the reasons, as I'll discuss later, why apartment values were so strong in 2017. Another macro issue is what's happening with the employment situation. Currently, we're about 4.1% unemployment nationally versus 4.8% a year ago. And I kind of like this chart. What it shows you is that job growth in the US, and we go back to 2014, we were averaging about 250,000 jobs per month. 2015, we got into about 225,000. 2016, about 200,000. We got to the first 9 months of 2017, and it was starting to slip a little. It went down to 175,000 jobs per month. But the last couple months have been strong. November and October saw a resurgence and averaged somewhere around 235,000 jobs per month nationally. Also, if we look at the GDP, you can see here that GDP the last couple quarters has been strong and has averaged about 3.2%, and that's about double what the GDP was for the previous 6 quarters. In terms of the Portland economy, this chart I really like, and what it shows is the lower figure is the national employment growth, the top figure is Portland employment growth. And you can see there that nationally we've been right around 2%, Portland about 3%. So it's one of the reasons that Portland Metro has been so strong and has gotten so much attention and why the market has been so good here the last couple years. However, the apartment market, or the job growth has actually slowed down a little bit recently. You can see here that in 2016, or 17, we're closer to about 2.6% employment growth. Now, the last couple months have been weak. in job growth. We actually lost jobs in November. October and September were both weak. So the latest figures show that for the last year that we've gained just about 26,000 jobs year over year, and somewhere about a 2.5% employment growth. But I think it's something we want to watch closely because the last couple months have been weak. Now, the next thing I want to watch closely is population growth. And you can see here, the blue figure is natural growth from births and deaths and the net increase. And the orange is in migration. You can see here that we've steadily added about 10,000 people on natural growth all the way back to the 1990s. But if you look at the chart on the right here, you can see the reason for our strong growth has been in migration. And the reason we've had good immigration is because of such a strong job market. And this has huge implications for the apartment market. If you do a few back of the envelope calculations on, say, average household size and the percent that will be owner-occupied versus renter-occupied, you come out with demand somewhere around 5,000 or 6,000 units. Also, if you do some back of the envelope figures on the relationship between jobs and apartment demand, it's somewhere around maybe one apartment for every 6 new jobs. And again, these are real rough figures, but what it tells me is, from getting some of these population figures and job figures, is that our demand is somewhere around 4,500 to 6,000 units per year. And we, as Patrick will describe shortly, we've been building a lot more than that, and it's the reason our vacancy rate has been going up. Another chart, or trend I consider critical, is what's happened with home ownership. Now, the home ownership rate, I follow this pretty closely. And it will have a lot of kind of false starts here where it might go up 25 basis points and then go back down, and you can see there. But what's happened this last year is that this is the first time we've actually had 100 basis points increase in the home ownership rate. So it kind of hit a bottom of about, or top of about 69%. It went down to 63%, and now is about 64%. So the reason this is so important is that it has such a big impact on demand for apartments. And just to give you a quick example, we've got about, let's just keep the math simple. Let's say we've got about 800,000 households in Portland Metro. And if you assume that 40% are renters and 60% are homeowners, if it drops 1 percentage point, basically that is a loss in demand for 8,000 units. So this is a critical figure to watch and has a huge impact on the demand for apartments. Now, you can see here on this chart, it kind of shows the homeownership rate throughout the nation. But 3 of the 5 regions, the Census Bureau kind of felt it was statistically significant in that the homeownership rate was increasing. Now, shortly after those homeownership figures came out, I got an email. I get a weekly email on what's happening with the apartment REITs. And so here's an analyst with Schwab, but basically his conclusion was that the number of owners rose by 1.3 million, and the number of renters declined by 700,000 nationally. So you can tell these are very big figures. It can have a huge impact on nationally what's going on with the apartment market. Now, the next thing you're probably wondering about is apartment construction. Well, there's one person who kind of follows this as close as anyone, I think, in town, and that's Patrick Barry. He's written a pipeline report called the Barry Apartment Construction Report. We finished maybe 15 appraisals of proposed apartments in 2017, and he was the lead appraiser on all of them. So I'd now like to turn things over to Patrick Barry.
So first of all, I apologize for ignoring this side of the room. I'm stuck to the tablet over here, so I'll show some love to you guys later. So I want to talk to you today about apartment construction, vacancies, rents, and expenses. You can't get far these days without driving by an apartment construction project. And your eyes are not playing tricks on you. 2017 will be the busiest year since the 1970s for apartment construction. When it's all said and done, Portland Metro will have seen between 9,500 and 10,000 permits issued. This is our 5th year of continued strength in the apartment construction market. We had a huge surge of applications at the very end of 16 and the beginning of 17, and this was in order to beat the inclusionary zoning requirements set forth by the city of Portland. Just in December and January, or December of 16, January of 17, we saw permits, applications for 6,000 new units. That's more than most years we see total, just to give you a scale of how big that is. And if you're not familiar with inclusionary zoning, it requires developers of projects with 20 units or more to set aside a certain percentage of these units for rental or for rent restricted and income restricted tenants. So this has led to another trend, a surge in 19-unit apartments. We've actually completed 2 appraisals recently of 19-unit apartments where the developer hoped to build more but didn't want to deal with the IZ requirements, so they changed their designs, combined some studios, and ended up with 19 units just to avoid this requirement. And there's also countless proposed apartments now at 19 units. So where have these units been built? Everywhere you'd expect. Downtown, close in southeast, close in northeast, northwest. We've also seen a lot of activity in Washington County, Hillsborough, Tigard, Aloha, Beaverton. Clackamas County has been extremely slow. I'm not even sure it made the list here. Also, Vancouver's up there. So these are deliveries. So where is construction currently occurring? Well, again, it still remains strong in the urban area, but it's also moved to a few suburban areas. If you notice, Vancouver's up top. They currently have about 2,100 units under construction, according to CoStar. And during this current cycle, they've completed about 1,000 units. So there's about to be a huge number of units coming on in Vancouver. Clackamas County's now made the list. And we've also seen some shift towards East County. It's not on here. I think it gets linked in with Northeast and Southeast Portland. But we've recently completed our 4th appraisal of a proposed property out in East County. And I think with land values, this is going to be a trend that we continue to see. So our figures show, we have an internal database. We're showing about 11,000 units under construction, but there's another 35,000 units proposed. And this is a scary number, I admit it, but it should be taken with a grain of salt, just because of the way that ourselves and others account for this. If you have a property that was built or proposed in 2016, here we are, 2018, they haven't broken ground, the permit is still active, but there's been no permit activity recently. Is this still proposed or should it be taken off? So there's some kind of funny stuff going on with the numbers. And also some of these master planned communities like South Waterfront, where they come out and announce that we're going to have 1,200 units, but it's over 10 to 12, maybe 20 years. So when do you add these units? So this number gets kind of fluffed up a little bit. So take it with a grain of salt. But these aren't loose figures. These aren't rough estimates. I've actually gone through and itemized every single one of these properties through the different municipalities. Most of the activity is close in Multnomah County, kind of where you'd expect. 2/3 of the activity, 12% each in Washington County, 12% in Clark County. Then the rest of it is made up of Clackamas County and then East County and Gresham. But there's no chance all these units will get built. A lot of developers are going to pull the plug, and a lot of lenders are going to pull the plug as well. These are just a few of the projects under construction throughout the different regions of Portland. So let's move to apartment vacancies. You know, there's a lot of different vacancy surveys out there, and they come back with a lot of different results. And the reason for the variation is when these new units are added to the survey. So do you add the units to the survey upon completion? Or do you add them at stabilization? Or do you add them at 1 year or 2 years? So all these different ways of adding these new units accounts for these major differences. In general, every survey comes in between maybe 3.5 and 6% vacancy. I put most weight in multifamily Northwest, and they put us at about 4.4% vacant, and that's up 40 basis point from the previous survey 6 months ago. We're definitely seeing some softness at the newer units and softness in neighborhoods that have seen very high volumes of apartment construction. So what's happening with rents? Well, we have higher construction, we have increasing vacancy rates. I don't think it's a big surprise that we've seen a slowdown in the rate of rental increases. CoStar has us at about 2% year over year, which is pretty similar to what we see in the operating statements of these apartments. We're not seeing any major soft spots, but there's a few, with the exception of close in Northeast, kind of the close in urban area, and at the older vintage units that have been upgraded. And now these units are competing with the lower end of the new units. And that's really the only soft spot that we're seeing in the market. So if you pay attention to one slide, this is the slide to pay attention to. This slide tracks income growth versus rent growth. And everyone knows that apartment owners are in a bit of a political firestorm right now. And really everything they do comes under fire. And I think this graph explains it best. Income growth and rent growth were kind of humming along nicely together from 2006 to, let's say, early 2014. And then early 2014, things went awry. You had income growth steady at about 4%, and then you had rent growth climbing to about 10 to 12% for 30 straight months. And you can see why we're in the political situation that we're in today, is this graph right here. And while the trends reverse itself, and now rent growth is lower than income growth, the scars are deep and they're not going away. And we'll be dealing with this for the next couple of years at least. This is an interesting graph I wanted to point out. This is effective rent at units that were built after 2014. Keep in mind there wasn't much construction at all from 2008 to, let's say, 2012, 13. So when these units came on, they got good rents. But basically since 2015, there's been no significant rental increases in these new units. And you're even decreasing in some of these rents. Especially towards the end of 2017, we've been trailing off. So we have a combination of increased vacancies, increased apartment construction, and a slowdown in rental increases. It's probably not a big surprise that we're seeing some concessions in the market. Average new concessions we're seeing on brand new units is anywhere from 4 to 6 weeks. This is a pretty significant concession because they want to fill up as fast as possible. And this definitely has been trickling down into some of the lower price units. It may be seasonal, it may not be, we'll see when we come out of the fall, in the summer. But this is a property in Beaverton. They're offering a free 40-inch TV, so a couple $100 there. This is a property out in East County. They're offering free Wi-Fi. And then this is a property just a few blocks from here. Really small, 300 square foot studios, but they're offering 6 weeks of free rent. So I want to touch base quickly on expenses. You know, in previous years, we've skimmed over this because there really hasn't been much change. But this year's a little bit different. Property taxes first. Clackamas County is up somewhere in the neighborhood of about 5%. Washington County property taxes are up probably 3 to 5%. But then you move to Multnomah County, and we're seeing 9 to 10% property tax increases across the board. And this is because of the Portland school bond that went into effect just this year. Then you move over to utilities. Again, utilities have been fairly steady, fairly predictable over the years. But Portland's in the process of building a $500 million water filtration plant. And starting in July of this year, 2018, the utility has reported that the average utility bill will increase $10 per month for the next 16 years to pay off this water filtration plant. So that was for single-family homes. On a per-unit basis for apartments, it'll be lower. But it's still going to increase, and it's not going to go away anytime soon. And last is repair and maintenance. As Mark discussed, we're at record low unemployment. The apartment construction industry is booming. We're talking to property managers and owners that are having trouble retaining maintenance and repair employees because these employees are getting wooed away by the construction industry, who can pay far better than an apartment owner or manager can. And then now they're competing with these construction projects. Besides that, most expenses we see remain fairly constant, fairly predictable, but those are the major changes we see on the expense side, and with that, I'll hand it back to Mark.
Okay, great. Hey, thank you so much, Patrick. Okay, I'd like to talk just briefly about some of the politics going on. Now, the inclusionary zoning, it was a 5-0 vote by the city council. So pretty strong support for going in a certain direction. We also had, as Patrick mentioned, a surge of permits to get under the wire. And we've done a couple inclusionary zoning appraisals. And believe it or not, I don't think it's as tough as a lot of people think to deal with. Now, relocation costs. One of the provisions for the city of Portland is to pay relocation costs if the rents go up more than 10%. And so this has had a big impact on some of the things going on in the apartment market. It's put a damper on value-added properties, just because a lot of those are properties that have fairly low rents. People hope to reposition them in the market to get higher rents. It has also had a big impact on apartment sales and where the apartment sales are going on. What's happened is it's pushed some of the sales activity out to Aloha and Clackamas County and Milwaukee and Gresham and Beaverton and areas, Vancouver and outside the city of Portland. It's also had a big impact on apartments that kind of were seen as having an upside, mainly because that upside kind of is limited on what you can charge in rents. So we've also seen some relaxing of the housing standards in the city of Portland. And certainly homelessness, and I live right up the street here, you see it everywhere, is a major problem. But the city council has now permitted some camping out in tents and also in RVs. Now, there's also a lot of politics going on. And Rodman Rowe has been kind of the swing vote. Rodman Rowe has a very strong support on one camp and a very strong and bitter opposition on the other side. But there's clearly been a swing in the balance of power, and the Portland Tenants Union is a very strong organization and well organized. Now, I've been active in the Multifamily Northwest organization. We have our semi-annual meeting here in this room, and in the spring meeting, there was the PTU, Portland Tenants Union, was out in full force with the bullhorns and the chanting and the signs. So they're well organized and well supported. Also, we have some changes going on in the city council. You know, the voice of reason, I thought, was Dan Salzman, who's a real estate guy and a businessman, and he's stepping aside. And I think that there were a lot of battles in 2017, but there are going to be more battles in 2018. So what's happening with apartment values and what's happening with apartment sales? If we look at these charts, there are really two ways of looking at it. We can look at apartment sales activity by the number of transactions or the apartment sales volume in terms of dollars. So let's look at both of these. If we look at transactions, we can see here that in 2016, there were about 285 apartment sale transactions. And in 2017, there were about 205 sales. So it was off about 30%. But what's really happening is 15 and 16 were record years. What we're doing is we're getting back to a normal apartment market. And we may say that things are down 30%, but it's also the third or fourth most active year we've ever had. So 2017 really was not a bad year. Let's look at dollar volume. Last year we did 1.4 billion in volume, and that was opposed to 3.1 billion the previous year. So again, the volume was off 55%, but it was probably the fourth most active year we've ever had. So again, we're getting back to a more normal market. If you look at the volume by quarter, And I kind of like looking at these figures to make sure some of the trends aren't thrown off. You can see there was a big spike in December 2016, but 2017, it was fairly slow, a little higher in the fourth quarter, and so fairly steady activity throughout the year. In looking at apartment sales, let's say in different market segments, if we go to sales of properties 10,000 and over, you can see that there were about 32 sales last year in 17, and this is compared with 58 sales in 2016. But even though it was off 45%, this was also probably the fourth most active year in terms of sales over 10 million. So again, we're getting back to a normal market. So let's talk about apartment values. If you take every single sale of every single apartment in the entire metro area, and you look at the median price per square foot, you can see here that apartment values were fairly stable from about 2017 to 2013, maybe some gradual inching up and gradual increases. But 14 and 15 and 16 and 17 were very strong, and we're now at record apartment values. The trough was back in 2010, and since 2010, apartment values have increased a compounded 12% per year, and it was up about 15 to 18% this last year. Apartment values have more than doubled since 2010. So what I try to do is also maybe take this a little further and look at sales, say, on a semi-annual basis. And you can see here that values for the last half of 2017 were very strong. So a big surge in the last 6 months of the year after two previous 6-month periods where it was fairly steady. Again, if you look on a quarterly basis, you can see that a lot of the increase was in the fourth quarter of 2017. So let's look at market segments. Now, one market segment is units built from 1900 to 1950. And these are mostly in Multnomah County. These are the kind of properties everybody wants. They're the single-level brick courts. They're the cute old buildings in the urban area, and a lot of trophy properties and a lot of well-located properties. So these values took a significant increase in 2017 and were up considerably. There was a huge run-up in values, but there were not a lot of sales. Another market I want to look at are newer units. And this chart has the number of transactions, cap rates, the median price per square foot, and the average price per unit. And this chart, to me, is pretty important because these are basically new units. And a lot of the new units are built for sale. You can see from this data that the cap rate is up a little bit in 2017. The median price per square foot is down a little bit, and the average price per unit is down. So my figures show that apartment sales are down for the newer units, are down maybe 2 to 4% in 2017. And partly just because so many units are coming on and rents seem to be flattening out. Now, with regard to specific sales, I'd like to talk about 5 certain sales that show trends going on in Portland Metro. Now, the reason I consider this sale important is that this is big money coming into Portland. Now, you and I and the people in this room are not working this market, but what we've got here is a company with $400 billion in assets, with $110 billion in real estate, and they're buying properties in Portland. Now, if anyone would like to invest in this company, you can do it. It's probably too late today. You can do it tomorrow. And you can go to the website, get qualified as an investor, and invest in their real estate funds for this kind of property. So what they're doing is pooling a lot of big money nationally, and they've come to Portland. This is a small acquisition for them, but it's a huge acquisition for Portland, and it shows that one of the biggest investment companies in the nation is in our market and wanting product. There are a couple other sales I'd like to just briefly talk about. This is a property up in Vancouver. The buyer is a value-added Portland investor who's always invested in Portland Metro, but he's not invested in Portland Metro, he's going somewhere else for his value add because of some of the political things going on. The next sale is a smaller, brand new apartment in Lake Oswego. And the only reason I put this up here is that record low cap rate, record high price per square foot, and a good location, but it was architecturally designed. And there's so much marginal design of some of the new units. This guy spent a little bit more, and it clearly paid off in terms of value. The next sale is a property out in Estacada. And the reason I included this up here is that people are pushing out to the fringe. You can see here that this is a property, you can see the apartments, but you look in the background and you're looking at farmland. So because Portland Metro has been picked over so bad, you're getting people who are pushing out to the fringes and to some of these smaller markets. And the final sale is the kind of property that everybody's looking for. And the price here, it's only 8 units. It's over at about 30th and Morrison, somewhere around $240 a unit. But this property is selling for close to what brand new properties are selling for on a per square foot basis and per unit basis. So you get very strong demand and a lot of interest in the urban properties. So when I started out, I mentioned, are we going to return to the mean? So this is basically a linear regression chart of the median price per square foot for every sale of every apartment going all the way back to 1989. And every time we have gone below the median price, below the trend line, it's pulled back. And every time we've gone above it, it's pulled back. Every time we've gone below it, it's pulled back. You can see here we are way above the trend line. So we look at not only the price per square foot, but also the price per unit, and you get the same figures. And so if you look also at the stock market, and these figures are through December, end of the year, basically the price earnings multiple, and I follow this pretty closely, it just keeps going up and up and up, and all of a sudden your price earnings multiple, if you throw out the dot-com bubble, we are higher than we have ever been, including Black Friday, just before the crash in 1929. So it really begs the question, are we in a bubble? Well, I think it's one of those questions that answer is no. If the economy holds and interest rates stay low, and the answer is yes, if the economy goes south and interest rates go up. And I think it's really that simple. So I'd like to now kind of talk about a few random things before we kind of get this wrapped up. The first is URM, unreinforced masonry buildings. How many have seen the report that came out in the last, anyone who is working the urban apartment market and URM buildings, this is a must read. And the city council has been working, not the city council, but they have had people working on this report for a number of years. And it really all got started by Catherine Schultz's article in the New Yorker quite a few years ago about the big one. So there's been a tremendous political wrangling and push and pull. And if you look here at the committee members, there are prominent apartment owners, lenders, bankers, engineers, city people, people from nonprofits, and there are probably 30 or 40 people listed that participate in this report. they finally come to a conclusion about what they want to do. And so, huge impact. There are about 260 apartment buildings that are URM buildings. Now, the upgrade costs, there are, I believe, 4 different criteria. One of them is the highest, maybe hospitals and schools and fire stations. And then you have the next criteria down, and then you have a lower criteria, and finally a very low criteria, single level units with fewer occupants. But most apartments fall in the category of, and they've estimated the cost here for the for the seismic retrofit, the cost somewhere between $51 and let's say $69. So I don't know if these are accurate or not, but I certainly presume they are because there are so many qualified and strong professionals that are on this committee. So how is this going to impact values? If you assume the low end of $20, that's about 5% of value. If you assume the high end of closer to $69, that's closer to 20% of value. If you assume the, say, 51 to 69, that's about 15 to 20% of value. So a huge impact for the URM. Now, there are various proposals, and the report is fascinating to read, but you have that says balance between the people who, the owners who just felt they were being hit so hard that they couldn't afford it and they might have to tear down the buildings, and the city council wanting safety but also wanting a reasonable method that's going to work. So there are all kinds of methods how this is going to get financed, and various proposals out there in the report. One of them is to exempt the property taxes for 15 years. And what's interesting is the report recommends that before ending mandatory seismic upgrade come about, that the property tax exemption go into effect. There are also some federal tax credits. There's also a transfer of the FAR, floor area ratio, which you can take your rights, unused rights on a site and transfer them to another site and sell those rights under the bill. There are also some business license exemptions. And what's interesting is they also are proposing that when tenants have to get relocated to do the seismic upgrade, that owners won't have to pay the relocation costs. So there are a lot of things to shake out, but really anyone involved in this market, this information is critical. There's an obvious reason why some lenders are not loaning on URM buildings. And I think that this report shows some of the risks. Now, this makes me nervous. As an appraiser, when we take in an appraisal of an older building, the first thing I do is check the URM list. But what they're saying is that about 100 buildings have been falsely identified, and about 119 buildings have been added to the list, maybe that were not on the list but should have been. And as an appraiser, the cost implications are so huge. And there's a provision for having an engineering report done. And I should tell you that I involved in 2 URM appraisals this last year. One of them had an engineer, it was for a lender, had an engineer saying, gee, this is on the list, but it shouldn't be, and he went through all the reasons. His obviously motivation was to get the lender to do the loan. Another one was a property that was being sold, and the buyer went and got a report saying, gee, the property's not on the list, but we think it should be on the list. Of course, they weren't going to show the report to the city, but they were trying to beat down the seller on the price. So you have a lot of kind of political polling going on in that. I'm also aware of at least one instance where there was a broker sold a URM building. Somehow the buyer did not feel there was adequate disclosure, and he found out after the fact, so you've got some litigation going on there. Right now, we're working on a URM building appraisal. It's a tough property. It's got a lot of issues, but it's selling for a record low for sales in the last 2 years. I don't attribute that solely to the URM issue because there are other issues with the property, but clearly this is going to be an issue that anyone involved in apartments here in Portland is going on be well aware of. Now, we've done enough appraisals of URM versus non-URM to kind of get all the sales of URM and all the sales of non-URM and try to figure out what the difference is. And it's tough to do because there aren't a lot of sales, not a lot of good data. A lot of the URM buildings are trophy buildings that everybody wants. So, but our figures show that there's basically about maybe 25% basis point difference in cap rate, which translates to about a 5% impact on value. Okay, a couple other sort of random issues I'd like to talk about. Apartment construction, margins. The appraisals we were doing in 14 and 15 and 16, the margins were incredible. And that's one reason so many people have been building new apartments. And we keep a spreadsheet showing all the costs. The margins are getting squeezed. And it's partly because of the construction costs have gone up so much. Also, some of the land values have gone up. But the margins, they're still pretty good, but they're nothing like what they were 2 and 3 years ago. Also, labor has been a major problem for apartment construction, just getting the bodies out there to do the work. Some developers are going out of town to try to get crews and contractors, but clearly the construction industry has full employment. Land values, I think the verdict is still out. What impact is going to be on IZ? We're watching that pretty closely. There's not really enough data to tell right now. Another trend we're seeing is investors reaching out to other markets, to the fringe. And with Portland Metro kind of picked over and cap rates in the 5 to 6%, maybe you can go out to other markets and get maybe 6.5 or 7 or maybe over 7% cap. And it might be Canby or Forest Grove or Longview, or I think I had a property in Estacada, Salem, Woodburn, Rainier, the Coast, Corvallis, some of these markets. And the final thing I have up here is I've noticed a lack of a discount for risk. And in the old days, maybe I've been doing this too long, but certain properties, you have a certain sense of maybe issues that are important. And it might be, say, a property not at stabilization, a property in the floodplain, a property on a busy street, a broken condo, maybe it's high crime or gang activity, or maybe it's a tough neighborhood, tough tenant profile, maybe it's joint uses, adult entertainment or marijuana sales or whatever. But in the old days there used to be a discount. It seems like the market has been so strong and that you haven't seen the discount that we've had in past markets. So, where are we going from here? What kind of year is 2018 going to be? Well, Urban Land Institute came out with their figures, and they rank Portland as the 13th best overall real estate market in the nation. Still pretty strong, and I believe that there are about 75 markets that they cover. So, favorable ranking. They also had Portland as the 11th best apartment market in the nation. So still pretty favorable numbers. If we look at some other figures here, we can see that the rent growth was quite strong. I think Patrick had this earlier, but rent growth has clearly pulled back. And it's back to, even a little lower than CPI. I went out on an appraisal 3 weeks ago, 50-unit property. There were 6 vacant out in Tigard, 6 vacant. They were asking $11.25, and they dropped the rents to $1,000 to get them filled. So all of a sudden, the market, and part of this is seasonal in that it's tough to rent units, but clearly it's not as buoyant and as strong, and we're getting back to a normal market in terms of rent increases. In terms of vacancies, the CoStar figures are showing about 6.5%. I would guess, I'm not sure where they get their figures, but I would guess that a year from now, we're going to be maybe closer to 5 or 5.5% because we're building more units than there is demand. The next thing is job growth. Now, I'd mentioned that Portland Metro has been very strong. Here we were right in the like 3% job growth. It's pulled back now closer to, say, 2.5. The forecasts are with the state of Oregon and some of the forecasters going to be closer to 2% job growth. So we've got 1.2 million jobs about. So 2% is what, 24,000. And if you take year over year, in 17, it was about 26,000. So they're saying that, and those are good numbers, 24,000. If we can be at 24,000 jobs, I think we're going to be in pretty good shape. But getting down the road a little bit, they're forecasting down to 1%, so that would put us about 12,000 jobs. Okay. So where are we in the cycle? I think this is something everybody talks about, and here's my guess is we're somewhere in the hyper supply. So hyper supply, which is of course well along in the cycle here, but it still could have some room to run. Hyper supply is defined as increasing vacancy rates. Yes. Moderate to high new construction. Yes. Low to negative absorption. Well, the absorption is not too bad, but it's not as good as it has been. Moderate to low employment growth. No, we've had pretty good employment growth here. And finally, low to moderate rent growth, which is yes. So it looks like we're clearly well into the cycle. Now, food for thought. I'd like just to present another opinion and a devil's advocate. This is a company called Black Creek Group that goes through, and they have a fascinating website. They go through all the different markets for different geographic areas in the country. And they try to figure out where each product type is the cycle. But they cover probably maybe 60 different areas, and they have Portland as being well along in the cycle and clearly towards the end of the cycle. I think we all have our thoughts on this, but I think it's something that anybody who's been through a few of these cycles, like many of you have in this room, this is something to give some thought to, just where we are. So in conclusion, where is our apartment market going in 2018? So I'd like to get back to the 5 macro indicators that we talked about. And they are interest rates. Okay, interest rates, low and stable, but the Feds have kind of tipped their hand that what the last figures I've seen, 50 basis points in 2018. So maybe affordable, but moving up a little bit. Employment, strong, but clearly some slowdown expected in 2018. And we're going to want to watch those job figures because the fourth quarter was kind of tough for Portland Metro. Population growth has been favorable. There's some, still, you get the moving companies and they report their figures, and Portland Metro looks pretty good. Home ownership ratio, that is probably moving in the wrong direction, and my guess is that it's going to go up before it goes down. Apartment construction, very strong. So, in conclusion, the apartment market here in Portland may still have some legs left, but I consider the two biggest risks to be what happens with the economy, because if the economy slows down, we're not going to get the population growth and we're not going to get the people to fill these apartments. The second big risk is that on apartment construction, Patrick's figures show that we've got, 9 to 11,000 units under construction. And it's like a freight train moving forward. You're not going to stop it for a while. You also have a lot of people who have made a commitment. They bought their land, they've got their plans, they got their level 1 and their survey, and they're well into it. And they've gotten their investors lined up. Even though they may have not broken ground, they're deep enough into it, they don't want to pull the plug. So I think the second risk is a lot of construction coming on just when the market slows. This winter is shaping up as a challenge for new units coming on, particularly units at the high end. I think we have already seen a gradual shift from a landlord's market to a market more in balance, and I think this will continue in 2018. Some final thoughts are there are clearly some good reasons for caution in 2018. So that's kind of how I see the apartment market. And David, if there's time for questions, we're certainly available.
I have a question.
Yeah.
So the state just adopted the new law after 2018 that all real estate transactions have to have a URM report. You have to do a seismic analysis on your property prior to sell. It's just coming out this year. In fact, it was just sent to us by RMLS, or by the state. Along with that, they're also telling you that they're offering up that tax abatement for that period of time that you need to upgrade your properties. And it's all URM properties, it's not just apartments. And do you see that as being a difference in value when new properties that have been developed right now probably had to meet seismic requirements based on what the rules and regulations are right now versus the ones that were built many years ago that weren't built under those same circumstances? Is that going to alter the valuation of the property?
You know, the verdict's out, and we've taken every sale of every apartment, non-URM, older, and then compared it with URM. And we're not seeing a significant discount. Now that this report is out, and they're making clearly some traction, I think we're going to see a discount because the numbers are so big. But if you look at the incentives, boy, you can tell that there was a lot of twisting and pulling and negotiating because there are a lot of incentives now, in particular, property tax abatement for 15 years or the cost of the URM. So as an appraiser, I want to be watching these sales closely, but right now, I mean, I can't help but think that there'll be some pressure there, but I don't have kind of hard data to support that. Yeah. Yes, sir.
If I understood Patrick, there was a slide in which he said that rent growth from like 14, 15, 16 was up like 10, 12% a year. And another slide that said the individual units, 1, 2, and 3, were fairly flat over that period of time.
That was just for brand new units.
Brand new units, okay.
So when you take the overall market,
Okay.
that's what gets you to the.
Okay, so it's the older units that can really drive that.
Correct.
right?
Yeah.
Thank you.
Mr. Ostroff.
Since inclusionary zoning, the map rush permits, what do we see as far as permits coming out now?
You know, Nick, maybe I'll have Patrick answer that.
No question for the big slowdown permits. A lot of the larger projects that we've seen flagged, they're subsidized to begin with, so they don't even care about the ID. But there's also been a lot of smaller info projects. Not a lot of people are tackling that either. There's a lot of kind of sitting and waiting. But also, it should be worth noting that when you apply for your permits, you can string this thing out for 2 or 3 years. So stuff that was applied for, and the first month of 2017, it could be 2 or 3 years before this pre-IZ property was built. So it's not like the things that break ground tomorrow are following IZ. They could very well be.
Just let me know when you want to cut it off.
A couple more questions?
Yes, Gerald.
So I had a couple questions related to the URM numbers. I mean, the repair costs of $60 a square foot are huge compared to values, and yet that chart that you showed that had that number suggested a benefit cost ratio of greater than 1. So I'm wondering where that came from. The other question I'm wondering about is the lack of discount for URM properties. Is that coming because property owners are insured against the low probability risk of a gigantic earthquake?
You know, those are good questions. The reason for the lack of discount is if you look at the URM buildings, a lot of them are historic. They're trophy buildings. They're beautiful buildings. And I think the market has been so strong and so picked over, and that people have looked beyond this discount, you know, to answer the reason why there hasn't been a difference. Now this report is out, I think that maybe some firming up how this has all come together. The second question was insurance. My impression is that insurance does not cover any of this. That if you have an earthquake, you better have earthquake insurance as a supplement. And a URM, I think it'd be kind of tough to get. And the third question,
Well, the report talks about a benefit cost ratio for putting in these improvements well above 1, so that begs the question, is that benefit on the public sector, not on the owner?
okay, they hired some, quite frankly, I don't understand all the cost-benefit ratio. There are lots of benefits. One of the benefits is that tenants might think the owners be more responsible if they do the URM. There may be other public benefits, but it's in here, but maybe, I'm not up enough on cost-benefit analysis, particularly the public benefits, to understand how they come up with that ratio. But this report goes into some detail. It's just that they don't explain how they do it, and I think that's kind of a field that is out of my league. Yes, sir.
Is this URM, kind of two questions, is this URM going to be a statewide code or a PPC code? There's not a lot of URM outside of the city of Portland, very little. And this happens to be a city of Portland report. Being a Portland Metro appraiser, I'm not up to speed on what's happening. So I can't really answer that question. One more question I'd like to ask you, is this the apartment dwellers, the people that live there, this movement that is trying to get rent control, is this infection going to go statewide or going to stay in the Portland market? What's your thought?
We go through cycles, ups and downs, and right now we got the rent control, but what's really happening is the market is having rents below, fairly low, and even pulling back in some markets. So I think the market is going to take care of this. Maybe there's political pressure going on in other communities. I'm not aware of that, but it may or may not. It just I just work Portland Metro, so I'm kind of a one-trick pony.
Okay, two more questions.
Okay, yeah, Ken?
So you said that sales volume in Portland was off by a third last year for apartments. Is that similar to other U.S. cities?
The volume has been down across the country. And just from what I read, this is not untypical. And really, it tells me we're getting back to a normal market. And 16 and 17 were so hot, so strong, and so off the charts, but still, 17 was a good year.
Are you seeing lenders get more strict on financing the construction of apartments right now?
Pardon me?
You mentioned you're doing a lot of appraisals for construction. Are you getting the sense that lenders are getting more?
What's interesting was from mid-December or early December, all of a sudden we're taking in all these appraisals of proposed apartments, and it surprised me. But what I realized was people were teeing up their projects because they wanted to get the financing and the permits and get it in place for construction, to start in the first part of the year. I am hearing more pullback from lenders in that they're scrutinizing things a little closer. They're watching the numbers, and they don't want to get caught. So my guess is that we're going to see a lot more scrutiny and a lot more detail. But I'll be honest with you, Nick, I don't have hard figures to kind of back that up. It's just kind of my sense which way the wind's blowing.
One more in the back.
Thinking about the tertiary markets, are they going to be sort of following what's happened in Portland, or are they sort of leveled off as well, or do you feel like they're going to actually increase the performance effect on
gosh, the tertiary markets have moved up. In the old days, I'm sorry, you're talking tertiary Portland Metro?
Yes.
In the old days, if you went out to Canby or Estacada or Forest Grove or Newburgh or McMinnville or up to Longview, I guarantee you that there was a discount. But now there's a discount, and that discount, my guess is that it might be 50 to 100 basis points in cap rate. But it's clearly made for a strong market for properties, communities that are not too far out, like Forest Grove or Canby, or down in McMinnville and Newburgh and some of these markets. So that's kind of my impression, and we tend to do work in all those different markets.
Mark, we have one more question in the back. Did you?
Oh, yeah. Sophia from Portland State. What is the overall forecast you see for Vancouver? I know it was on the top of the charts for multifamily.
You know, Vancouver didn't have a lot of construction there for a while. It's come on pretty strong. And my guess is that Vancouver will kind of mirror Portland Metro. You got a lot of units coming on. Rents are a little bit lower up there. Values are pretty firm. And my guess is that you're going to see some of the same trends happening in Vancouver as throughout Portland Metro. But
Do you mean particularly like the going out to the fringe, like Portland moving?
well, you know, really that would depend on the zoning laws and all that. But just in terms of values, I think, and vacancies, and I think we're going to see some of the same trends up in Vancouver as we're happening in Portland Metro.